All right, Phil, before we start with anything else, just 3 days in, your thoughts on this SpaceX, this debut?
There's a lot of things happening. The options play is obviously more people go long the options, the more stock you need. Remember, there's a very limited float and there's gigantic demand. And I feel like it's this Elon Musk driver because of what happened with Tesla. So I don't want to miss out on this. And the reality is, if you've ever used Starlink on a United plane, it's amazing. It's incredible. You wouldn't have a war between Russia and Ukraine without it. So the idea of going from a $175 billion firm in revenue to $1 trillion is something to behold. So I take it with a bit of skepticism in that when traditional IPOs pop and then drop,
right.
This one seems to have enough euphoria, and it's so thinly traded that for now, if you got into it, you made a couple bucks, do me a favor, take a little bit off the table.
A little.
Take 10, 15%.
But at some point, longer term, you think you'll be an investor. Like, let's say it does pull back.
And truth be told,
yeah.
Because there are 3 things happening this year that I think are fabulous. SpaceX, Anthropic, and OpenAI. All those are going to go into the queues. So if you want to go out and buy the NASDAQ 100 or something like that, that's going to hold those names. And the reason why, the euphoria is just too hard to miss. So I think you got to take advantage of something we've never seen before. And whether the revenue matches the story, is the juice worth the squeeze?
Right.
I think the answer is yes. So I would say participate, but as you get these big gains, always take a few chips off.
For the broad market, I want to bring up the infamous Gartner hype cycle. It's kind of interesting because Gartner itself stock went from 500, it's like $100 right now, 150 bucks.
Yeah.
So, but where do you think we are, right? Because we've been through this before, and you get the technology trigger, you get this peak of inflated expectations, and then it all goes away. You know, I think Wall Street thinks we've been here for the last year, and maybe 2 years. A lot of folks on the street missed it. Where do you think we are in this curve?
You said something early on, and I would surmise your opening comments this way. Productivity enhancement. You put up Corning up 114%. Why is that valid? Because they make the fiber optic cables that are necessary for a data center. So while we are in this kind of euphoric up here somewhere, whatever the case may be, I think you have a scenario where we haven't yet understood the impact on productivity. And if productivity really rips higher, the way it's shown to have done certain quarters, then my buddy, we're on a chance that this thing is just beginning to really have impact across multiple companies. It's almost as if every company is AI impacted now. We just need to understand what it's going to mean for their revenue and how much they can grow from it.
You mentioned the 5% float. I talked about that also with a guy who was like one of the early investors. The opposite for the broad market.
Yep.
We went through a 20-year period where every year stock was coming off, right? Yep. Some even say this was a stock market version of quantitative easing. And it was beneficial, right? Of course, supply and demand. The less supply and the more demand, the more inflation or inflated prices. Willie, do you think the exact opposite will happen with all of these IPOs coming on?
I regrettably say no. And the reason why, not from the answer you think. There are more new businesses started right now than ever in American history, even more so than last year. What's happened, though, is the regulatory environment is so difficult between the accounting standards, with FINRA and the SEC want, and the cost of going public. It makes everyone delay longer and stay private longer. So while I'm excited that there's some pop here, it's not nearly enough to fix what's happened. What you outlined here is one of my biggest concerns for Main Street, that there's less stocks people have access to, and especially when they're younger and growing.
Right.
It worries me. I don't know. I think this is temporary, unfortunately.
All right, so let's talk about listen, the market, the AI warnings. Again, this is something that we've been hearing for a long time. Even around here, AI is too big of the pie. It's unsustainable. Are you concerned? Because I believe there might be a day we could argue 80% of the stocks out there are AI related. At some point, they're all going to be AI related.
I would bet you $1 a year from now, the S&P and the NASDAQ are going to trade almost in lockstep. Why? Because the S&P is going to have 60, maybe 70% in 15 to 16 names. So what's happened is, while AI is impacting every company, whether it's Corning or a small cap, mom and pop startup, the reality is the indexes are no longer a passive index. They're highly concentrated in a handful of names. I think it'll look very similar. It's why this show and what we do about diversifying and looking for other opportunities is going to be critical, because I am concerned about what AI means for indexes, and I'm more concerned about whether or not productivity bleeds into the rest of the market.
So there's a lot of scuttlebutt about people selling stocks, to buy SpaceX. The question is, you have CTAs that have maxed out. Everyone's maxed out. Rick Reeder said yesterday that he thinks a lot of money is going to come out of money markets. It's about $8-9 trillion there. I mean, what do you think? I mean, some money has already started to come out in the last few weeks.
Yeah, maybe $1 trillion or $2 trillion. I think he's wrong. And the reason why, people love getting safe money at 4%. If you tell me that...
What if interest rates start to go down? What if we start to get 3%, 2.5%?
So you're hitting it. You fall below 3 and you're below the rate of inflation, things start to change. But it's not to say that you're going to go from 10, 12 trillion down to 4.
Right.
You have 2, 3 trillion, maybe 4 trillion. Cash has always been a safe haven for opportunity, and especially because I don't see interest rates. Look, I'd love to see the 10-year down at 350, 375 because we get some deflation.
Right.
But we got a long way to go to get there.
So you like still SanDisk and Micron?
I do.
Okay, year to date, one is up 788%, the other one's up 281%.
Yeah.
Now, I'm sure in this because this is your year-over-year contracts for these DRAMs, folks.
Yep.
It's gone parabolic. This is the history going back 25 years of pricing. So DRAM prices just have gone down and down and down, and all of a sudden they're breaking out. I think you're saying that what's happening here is following this.
Exactly.
And if that's the case, these stocks still have more room to the upside.
You could argue Micron Technology, MU, is trading at maybe a 10, 12 PE. And the reason why, if their demand cycle, you see it, you have it up there on the board, whether it's SanDisk or Micron, what you have is a scenario where the picks and shovels of AI, specifically memory in this case, DRAM,
right.
If you meet those obligations, these stocks are still cheap.
Right.
And what you once said about a month ago, Micron reminds you a bit of NVIDIA. You're right. Because NVIDIA is the only place you can go to get their chips. Well, Micron's pretty much the only place you can go to get the real memory. And in that scenario, if the demand continues, and as of now it's certainly there, if it doesn't wane, you're getting it cheap. Now, if you made a bunch of money and you're up 1,000% or wherever you bought it at, depending on which one you bought, I always advocate taking some money off the table.
Some. Keep some, though.
Exactly.
This ride may have... We do know they have contracts that go out a long ways, and that gives us visibility.
And for the folks that aren't in it, just wait for an opportunity. They'll come. The opportunities will come when you maybe get a little bit cheaper, but there's nothing wrong with averaging in slowly.
By the way,
over time.
they come fast.
Yeah.
So, it's like an old Mike Tyson fight. I hope you're not getting a cup of coffee when they come.
That's true. That's true.
Real quick, you're an advocate for consumers.
I am.
And so I shouldn't be surprised that you like Hyatt here. Listen, one of the things we don't give up is travel, huh?
Well, years ago, you and I talked about Marriott, and my gosh, that thing's gone parabolic. I think this thing's beginning to do the same. If you overlay the Marriott chart on this, it's not nearly as sexy. So why I think this one's lifting off, a real increase in the demand for hotels. Beyond that, their own internal partner program, very impressive, and their expected earnings growth is double digit. So I think you're finally in a place where, by the way, lower gasoline, down at maybe $3 a gallon, you're going to see a boon for travel again, and Hyatt's going to win on that.
Less than 30 seconds ago, real quick, tomorrow, FOMC meeting wraps. Kevin Warsh steps up to the podium. I hope Powell's not standing there. Just out of habit, just out of habit. Yeah. What do you think we're going to hear?
He said something over the weekend I love, which I'd like to see the Federal Reserve stop talking. The never-ending scenario of these guys talking their book is killing me. I'd love to see the day when the Fed is no longer a talking point.
Right.
That's what I hope he talks about tomorrow. He's not going to do anything tomorrow, but he talks about the new Fed is going to focus on 3 things: interest rates, employment, and reducing the balance sheet so it's not so much influencing markets. That's what I want to hear, and I think he's going to do it.
Yeah, I'm with you, man. Nothing worse than you look at the slate of talkers, Fed talkers for the week. Great stuff.
My
really
pleasure.
great stuff.
Thank
Thank
you,
you, Phil. All right, folks.